Okay, so how do we actually mechanically define that it's fresh? Well, let's say for instance we have this candle, or this zone I should say, that breaks this high. Now obviously the candle that I'm pointing to here, you need to wait for that candle to finish printing to then be able to draw that as valid demand, right? Because remember, the candle needs to close above the previous candle's high for it to be valid demand, okay? Now, at that point, you can see that price, since that candle had closed, price has not traded back into it. So now we have, or we can say that any orders that have been left within there, right, those split orders, they can still be unfilled because price has not come back in to touch them. So we're increasing the probability of a decent reaction when price returns there. And that is what we call the liquidity gap, okay? So from the high of that initial candle to now where price is moving away, we can say that the zone is fresh until that gets filled, until price comes back into the zone. So here you can see when that zone was created, right, that first yellow circle, price came back in and tapped it, and that led to a significant move. Now, yes, it only tapped the top of the zone, and it's quite a large zone, so there arguably is still a lot of unfilled orders within the zone. But for me, once that has been tapped, it drastically reduces the probability that when price returns there, you'll see a reaction that is worth trading. So I'm pretty damn strict on this, and I only trade from zones that still have that gap and are completely fresh. Okay, so here you can see, if you look from the left, from where the zone was created, you had that liquidity gap. Price has not traded into it until we look for that move to get in long, and they are the zones that I want to focus on, right? They are the highest probable ones that I find. So they're the two minimum criteria: at least causes some break of structure and is completely fresh. Now we're going to look at the other confluence. So flip zones, and this is where a zone flips another zone. A stack zone, so this is where it's nested within a higher time frame zone. A session zone, so this is where it's created during a high volume session. Trading pro trend, pretty obvious, but one we want to add in for sure. And then two of them that are based on liquidity that we'll cover in the liquidity section. So a flip zone, this is where you have a supply zone that basically overpowers a demand zone, or a demand zone that overpowers a supply zone.